We have a great question here from Mike asking how useful we think it is to mark out previous monthly, weekly, or daily highs and lows when analyzing various instruments from both a day trading and a swing trading perspective. So thanks for this great question, Mike. I think this will most probably be one of those things that mostly comes down to each trader's preference. But I will be more than willing to share my view on that if it will help. So I think these levels can be helpful, but only when they are relevant. And let me explain what I mean by that. What I mean by that is there will be times when previous monthly and weekly and daily closes will be more important based on where they occur on the charts, right? So, for example, when they are close to where they open and where they close, if that happens very close to significant price levels or significant prior swing points or significant psychological price levels, I think they are a lot more important when they occur at those specific areas on the chart. So for example, if you have a daily or a weekly close right on a very significant resistance or support area, that is a little bit of a two-way close from a technical point of view. Because depending on the sentiment and the fundamentals, the technicals are pointing to either a market that is getting ready to break out, but it couldn't break out of that level the prior week or prior day or prior month, or it might be showing a market that might be ready to consolidate a little bit before it breaks, or a market that might be ready to take a breather at that specific level. But if that monthly or weekly or daily, if it's a solid and strong close above that key resistance or below that key support, that gives a lot more confidence that the move can continue, as long, of course, as the sentiment and the fundamentals supports that move. Also, from an intraday perspective, when we trade quite a lot in the short term, we like to use things like pivot points when we take day trades. And these pivots are obviously also calculated based on prior highs and lows, depending on what time frame you look at them. So they should include those important daily levels anyway, which is why I don't really place too much emphasis on the highs and the prior lows themselves, unless they are, of course, showing significant swing points on the charts, or if they have confluence with other things like psychological price levels, etc. But from an intraday point of view, apart from just looking at the pivot points, looking at the prior day's highs and lows, I think is it's an invaluable tool to have in the market, because that'll show you where the most likely area of support and where the most likely area of and resistance will be in the very short term. So from a daily point of view, from an intraday point of view, I think it's very helpful to have those levels on the charts. But thinking of the prior day's high and prior day's low, it will show up as a swing point on the chart anyway, if that makes sense. So and it's not something that I'll mark out as I'll necessarily need to mark out on the chart as a specific yesterday's high, because if you just look at something like the pound dollar, yesterday's high created a swing, right? And the low created a swing as well. So you don't really need to look at those levels from going marking them out from a daily point of view. You'll be able to spot them, just as is on the chart, as the most recent highs and lows, if that makes sense. So when I prefer not looking at those levels is when they are just in the middle of a trend. So if it's a daily market, let's take something like equities, right? And we take a daily. Let's just hide some of these drawings. So when I won't really consider a daily high or close is if we have a trending market like this. These highs and lows, even on a weekly basis, isn't really something that I'll necessarily take into account, unless, like we said, they happen at key areas on the charts. If that prior low or high from a weekly or monthly or daily level, if that is an all-time high or previous swing low, or if they happen at those key levels, I think they're a lot more important. But when I won't really look at them is when they just occur arbitrarily, if we want to put it that way, just in the middle of a trend somewhere. Now, it is, of course, different when it comes to equities that are making fresh all-time highs, because then when that happens, the prior day's highs and lows will be very important from a intraday support and resistance point of view. That is, of course, true. But apart from that, I personally don't, mark them on the charts every day or every week. And it's not because I don't think they are not important or useful, but only because I think all the other things we look at on the chart already, like swing points, like psychological price levels, like support resistance structures, I think all those things we look at on the charts already show us those significant levels anyway. Whether they were the high or lows of the prior week or month, they will show up as significant levels on the charts anyway, and without marking them out as such. So, but again, that doesn't mean that they aren't useful to incorporate into analysis. I do know of many traders that do incorporate them. They've built indicators to show them, prior weekly closes or highs and lows and monthly highs and lows. And they do find it very helpful. And sometimes I do find those levels helpful as well. But as I said, normally when they happen at those key junctures, when they happen at those key levels already, I find a lot more value to incorporate them. So hope that helps with the question. Mike, any others, as usual, please don't hesitate to let us know.